All right, today we're covering section 18.3, and the focus of today's lesson is on what we would refer to as equity financing. The whole idea behind this entire chapter is we're having to come up with ways to generate capital in order to expand our business. A lot of times we don't have a lot of cash just sitting in the bank that will allow us to make necessary improvements or expansion, so we got to get sources of capital in other ways. Okay, so there's really two different types of entries that we're going to be dealing with today. I guess you could say there's four. We're going to be issuing both common and preferred stock. And we're going to issue those stocks at what we would say is their par value. And the par value you can just think of as the stated value that would be printed on the stock certificate. And that's just an arbitrary value that's calculated in various ways depending on the state. That's not really something that you need to know. You might think of par value as, let's just think of a ticket that you might buy to get into a UT football game. Okay, I think for the most part a UT football ticket might have a pre-printed, what is it, like $45, $50, $55 depending on where you're sitting. Okay, so kind of think of that as the par value. Now, whether or not you actually pay that amount from somebody that's selling that ticket on the street, you know, they might just be wanting to get rid of it. They might sell it to you for $10, so they've taken a loss. Or if it's a really big gain, they might sell it for $200 and they've taken a pretty huge gain on that. But the par value for stock is something that's pre-printed. It doesn't necessarily mean that's what we're selling it for. We're selling it for whatever the market says it's worth, but the par value will be what's stated on the stock certificate. So with that said, let's work through the transactions, these four journal entries that we're going to make on page 568. All right, so for number one, we're told on June the 1st, we sold 6,000 shares of $10 par value common stock, and we sold it at par value. Okay, so we sold it for exactly what the certificate said the value of it is, and they went ahead and did the math for you, so that's a total of $60,000. So our journal entry, remember, this is another way of accumulating capital. And what kind of balance does capital have? A credit. Okay, so think about how you would increase the capital account, and that's what we're going to do here. So our entry, of course, you got the date here. Let me do this in red. I think that shows up a little bit better. And this is June 1st. Okay, so I'm going to abbreviate because I don't have a lot of space, but the account title here is Capital Stock Common. Capital Stock Common, because there will be capital stock known as preferred that we're going to talk about later. The credit is for that $60,000 amount, and the debit to cash then will be also $60,000. Okay, and that takes care of an issuance of capital stock, common stock at par value. Well, on the 9th, it's a little different because it's $10 par value stock, but we're selling it for $10.50. So we're selling it for just a little bit more than the stated value. Okay, so this entry is going to look a little different. The actual credit to capital stock common, so here's that same account title we used before. We're going to credit this for the par value. So what would I put there for par value if it's $10 stock and we sold 2,000 shares? Do some math there. 2,000 times $10, 20,000. Okay. So notice we always credit these capital stock common accounts for whatever the par value is. Now, we said we're going to take in more than par value. We actually took in 21,000. So that difference is going to be to a new account that we haven't dealt with before, and it's called paid in capital. And I'm going to use 2 lines, and you'll need to use 2 lines for this too. Paid in capital in excess. Yeah. Paid in capital in excess of par dash common. So I'll read that one more time. Paid in capital in excess of par dash common. And in this case, that's $1,000. Credit. And so those 2 credits added together should be your debit to cash, 21,000. We took in a total of 21,000 cash. So there's an example of when we sell the stock for more than its par. Now, when you get to college accounting, you'll also look at the scenario when you sell it for less. Some companies might be a little desperate for capital, and they're willing to let their stock go for less than what it's actually stated for, and that's called a discount, and you don't have to deal with that. So we'll just move on. All right, so the only thing left, these other 2 entries involve a different type of stock. And let me just give you the short, the real major difference between preferred and common. All right, if you own preferred stock in a company, if dividends are paid, then you get your money, your dividend payments first before the common stock people get theirs. So if there's only so much money to go around for dividends, think of the preferred people get the money, and if they run out of dividend money, then the common stock people are pretty much left out in the cold. All right, so the preferred stock people get preferential treatment when it comes to things like dividends. Okay, so it's a little bit higher value stock, but they get some preferential treatment when it comes to extra money that could be available to them. Okay, it's not really any different though in how we do the journal entry. I just wanted you to understand the difference between those types of stocks. All right, so on the 22nd, you're basically going to do that same type of entry that we did on the 1st, because we sold the stock at par, and it was $30,000. So this time we're going to do capital stock dash preferred. And of course, you got the document number there. I haven't been writing the document number in, but you should be doing that. And that's $30,000. And you debit cash also for $30,000. And then our last entry is going to be a lot like this one that we did on the 9th. It's just that instead of common stock, it's going to be preferred stock. Okay, so we issued 500 shares of $10 par value common stock. Oh, that's common stock again. Okay. Wonder why they did 2 different common stock entries. All right, so we issued it for more than par. So we're going to have that paid in capital account that's going to be used again. So our credit is to capital stock common for the par value. And what's that? 50,000. Okay, and we have that paid in capital account. So just like we had before, paid in capital in excess of par common. Is it 5? I just heard somebody say 50. Oh, okay, it's 5,000. Sorry about that. Somebody said 50 and I just picked up on it. Thank you. Okay, so how much did we have in excess? So what's 500 times 1125? Okay, so that's how much we actually collected in cash. 5,000, you say 625? Okay, so the difference is what will go to this paid in account, which is 625. Yeah. Thank you. And this is page 6 of the journal, which I forgot to write in. All right. So basically that's the 4 journal entries that you need to know for 18.3. So we're going to do the on your own problem and the application problem.